Now I can see you.
This meeting is being recorded.
Good morning, everybody, and good afternoon if you're on Eastern Standard Time. We're excited to host Beverly Wilks today from the Bacon and Heels, and I'm going to pass it to her to introduce herself. But Women in Leadership is thrilled to provide information on money, saving, and owning your money today. So join us and drop any questions you have in the Q&A. And also, we'd love if you throw into the chat your location where you're dialing into this webinar from. Thanks, everyone. Go ahead, Bev. Nice to see you here today, and go ahead.
Nice to see you. Thank you so much. Thank you so much for allowing me to participate in this group. So hi, everybody. Welcome to the Women in Leadership and Bacon and Heels webinar on money. My name's Bev Wilks, and a little bit about me. By day, I'm a full-time marketer at Bell, and by night, I am a financial literacy. I like to call myself a cheerleader, really helping women to talk about money, talk about saving money, investing, and really making sure that we are taking care of ourselves. Why? Because we live longer than men. So we need our money to do double duty in order to ensure that we have a nice, long, healthy, and rich life. So without ado, I'm going to start the webinar. So let's really talk about money. One of the things that really I find interesting is a lot of women say that they don't talk about money because they think it's rude. This really is something that I've been seeing around North America and in the US and some parts of Europe. So we don't talk about money traditionally with our friends, nor with families, nor with our families. So I'm really on a mission to change this. And this statistic that came out was really interesting for me because 63% of women said in a recent study that they find talking about money is rude. So let's be sure that we feel good about talking about money. Let's be sure that we are not shy about talking about it, especially now. It's coming to the end of the year. Many of us are looking to get a raise or a bump in salary for next year. So unless we talk about money, that's something that we are at a disadvantage of, because not being able to talk about it means we're not able to ask for the raise and really learn more about why money is important to us. So let's get to the slides. Today, we're going to chat about getting ready, getting set, and starting saving and investing. I really want to dive into how to start investing. I get that question a lot. People are like, okay, I have all this money or a little bit of money. What do I actually do? How do I get started? We're going to dive into budgeting, or as I like to call it, a spending plan. And then start really digging into retirement. What does it take to have a good retirement? How much do we really need? We'll talk a little bit about tackling debt. And then this is something that I love us to really dive into is, how do you own your own money? That's very important to me. So let's get this conversation started. So by the numbers.
Sorry, Beth, thanks. I just want to say I'm really excited about this too, because I didn't realize when I was in my early career that even a little bit adds up. It wasn't until I was a bit more senior in my career. So I think this is a great opportunity to understand it doesn't matter how much you're making. You can start whatever age you are and whatever salary bracket you're in. So I'm excited to hear too.
Great. I love it. So here's a couple of numbers I always find interesting. So 40% of women currently invest in the stock market. I think that's great. On the flip side, 87% of men are investing in the stock market. We need to catch up with the boys and get our numbers up. The second stat, 22% of women feel that they are confident when investing. That number is very, very low. And I want to be able to tackle, why do we not feel confident? Is it because we think it's an all men's game? There's a lack of understanding, or just not feeling ready to do it? All perfectly good reasons. Let's try to find a way to get above that. And last but not least, did you know that 30% of dual income homes are led by women who own more than their partner? So very important for us to take a look at that as well. So how do you start? One of the things that I love doing about Bacon and Heels is it's a website, it's free. You can find it on baconandheels.com. All of the tools I'm going to talk about here are free, and able for you to download. I'm actually updating the site, and by next week and a half, 2 weeks, you'll be able to download these items. And according to our friends at the Women in Leadership, you'll also be able to get it for free in an email that they're going to send out as well. So I really want you to be able to leverage and use these interactive tools. So where do you start? Well, in order to know where you're going, you got to think about where you are today. Calculating your net worth is typically the best place to start. And really simply, I want you to add up every single thing that is an asset. Your savings, your checking, cash, retirement income, anything that's an asset, a car, anything that you could convert into dollars is an asset. I want you to take all that money, all those numbers rather, and then I want you to look at all the things, excuse me, that you owe. Your car loan, any school loans, mortgages, personal loans, credit cards, anything like that. I want you to take all those numbers, take all your assets, add them up, whatever the sum is, take all the liabilities, add all those up, take that sum and minus the assets and the liabilities, and then that's where you are. So it may take a little bit of time to pull all those papers together, but please do take the time to figure that out. And you may be surprised that your net worth is more than you thought, or it may be less than you thought, but it just provides you with a starting point in how to move forward. Oops, that did not work the way I wanted to. Okay, there we go. So the next topic is, a lot of people ask me, Bev, how do I start investing? So there are 3 things you need to consider. Yes, you always need to start early. I remember my dad, when I was like 22 and had my first real job, he was like, I want you to take $200 a month and start putting aside. That was his advice. Just start early. I don't care where you put it, a mutual fund, a GIC, I don't care where it is. Just start saving some money so that you have something to grow upon. And at 22, I was thinking, I got tons of time for this. I don't need to think about retirement. I don't need to think about investing now. I want to have a good time. And he really imparted on me the reason to save, because years fly by quite quickly and I'm still saving that amount every month for the last 20 years. So it's a great opportunity to start early. Now, if you are starting late, as they say, it really doesn't matter. I just want you to start. The big thing about investing is you cannot save yourself to wealth. Putting money in the bank account today, let's say you put in, I don't know, $500 a month or $200 a month, with the rate of inflation and the low interest rates that banks are paying, you will never be able to capitalize upon the magic of investing, which is compound interest. That is where, while you're in bed sleeping at night, that money is working for you and compounding on itself. So in order to be wealthy or gain some wealth, you need to be able to make that money work for you. So give that money a job. The second most important thing is, how much do you want to invest? There's not a rule that is one rule that fits everybody. If you would like to invest $200 a month, $500 a month, if you're able $1,000 a month, that's great. Think about what really works for you in order to ensure that you're putting as much as you can afford into a mechanism that could help you grow your wealth. And then, of course, you certainly need to open an investing account to make that actually happen. So when you think about investing, it can be real estate, stock and bonds, anything that you think is really interesting to you, that's the way that you should start. So here's what investing is not. Please don't jump on the trend. I'm not sure if you remember, a couple of years ago, Bitcoin was flying. It was like $65,000 for one Bitcoin, and people were making bazillions of dollars around the world. And a lot of people just jumped on that hot thing, that hot stock. Investing is not, in my opinion, that way to move forward. And why? By the time things are really hot, the people that already made the big money are already out. Everybody else is rushing in now because it's on the news. A lot of stocks that you find are things that you saw when you were on vacation. I'll give you an example. A few years ago, I was in Australia, and I'm lactose intolerant. So I go to Australia, the flight lands, it's like 17 hours. I get there dying for a coffee. I go and I get a coffee, and I asked the lady at the restaurant, I'm sorry, I'm lactose intolerant. Could you give me some other milk? And she says, no, 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 trust me, the milk here is good. Just drink this milk. Anyways, all that to say, drank the milk and the coffee, had no pay, no nothing. And I went and I looked up the company. The company was public. It was a milk company, small milk company. And the stock was $2. And now that stock is $10. So I was on vacation, I was there for work, looking around. There's always an opportunity to see something. So it's not about just jumping on what's hot. It's about just being more aware of what's happening in your surroundings in order to help you get to where you want to be. The second thing that investing is not, is you do not need to just buy stocks or mutual funds. It could be anything else that you think is interesting. It could be a GIC, which is a guaranteed investment certificate, where the money is guaranteed by the government of Canada, and they provide you with X percentage of interest. It could be 5-6%, which is quite high right now. And the third thing is investing is not only for the rich. I spoke a couple of weeks ago to some university students, and one gal said, you know, something, only my rich parents' friends or my rich friends are able to invest. If you could put $50 a month aside, $25 a month aside into an investing account, I just want you to start. And that's really important. So here are the steps to take. I want you to determine your timeline for this investment. So as the saying goes, the best time to plant a tree was yesterday. The same holds true for investing. The best time to start is now. As early or as late as you are, just start moving things forward. As we said, let's decide how much you would like to invest. We all have financial responsibilities. We all have rent, mortgages, we have other debt that we want to pay down. We got to pay utilities on our phones and loans and stuff. So investing is usually the last thing that we think about. I would like you to change that mindset a little bit and think about, okay, how much can you effectively put aside a month to start really investing? The third thing, you got to open an account. I want you to visit your bank or speak with your financial planner or advisor to talk about how you can open up an investment account. This does not need to be a fancy brokerage where you're paying tons of fees. It could be a discount broker at Bank of Montreal, CIBC, RBC. All these banks have discount brokerage accounts that you could actually leverage and use. So do a little bit of research. Talk to your bank and see how you could open up an account that really suits for you.
Bev, I'm just going to jump in. We got a question, and I think we touched on it, and we got a question in our Q&A. What if a person doesn't have that much income capital to invest? So I think you touched on it, and I think it makes sense. You know, if you have $25 a month, and it's amazing because I didn't start doing this saving my money until later. I also thought I had to be rich. I had to be established in my career, but it was amazing. Once I started taking that, and I started with just $100 a month. Once I started doing that $100 a month, I realized I didn't really miss it in my account. And I think I didn't feel I was really depriving myself. So I would say, you know, like Bev, even if it's $20, $25, just put it aside every month into the investment account. As Bev said, go to your bank, jump online. There's lots of opportunities online to open a small investment account. You don't have to have financial resources to do it. And many places, they're happy to, just open the account for you and slowly move your money into it. So thanks, Bev.
Yeah, and I agree 100%. I don't care how much it is. I just need you to start. $5 a month. I don't care. Just start getting used to putting that money aside. And remember, the money is not gone, right? It's there waiting for you. And yes, some investments do go up. And as we saw, investments do go down. But over the long term, you're more likely to make more money by investing, again, than putting into a savings account. So good question. We talk about investment options. This is what I find very interesting. Investment options could be stocks. And just to be clear, a stock is a share of an ownership of a company. This is also known as an equity. It could be a bond. A bond is essentially a loan to a company or a government entity, which agrees to pay you back a certain number of dollars by a certain time. In the meantime, you're gaining the interest. You can do a mutual fund, and a mutual fund is a mix of investments that are all packaged together under an investor. And this allows people like us to really skip the work of picking out individual stocks and really just purchase this beautiful package of diverse collection of stocks. What I like about that is it's already being managed by a firm or a bank or an investment firm, and they have a diversification of stocks in these individual packages, which generally makes it less risky for the individual because you're not holding individual stocks. And last but certainly not the least are ETFs. These are electronic funds, and it's like a mutual fund. An ETF holds many individual investments that are bundled together. The difference is that ETFs trades throughout the day like a stock and are purchased for a share price, unlike a mutual fund. So there's a couple of options here. Really want you to think about what could work for you. But again, you just need to open that account first. Even if you open the account and you put no money in it, that's step one. Just go and open that account, and then we can move that forward. And then last, but certainly not the least, you need to follow and track your investments. You don't just open the account and forget about it. It's about, but I also don't want you to be looking at your account every single day, because the last few months have shown things got a little bit wavy, like on a roller coaster, and I got whiplash looking every day. So really just once a quarter, take a look, see how you're doing. As long as you see that you are progressing and doing better over the long term, that is what's best.
That's helpful, Bev. I always struggle with that too. How often do I look? How often, what's the right times not to panic? So I like that once a quarter. That also feels manageable for me, not being an expert in money the way you are and some other people. So thank you. That's actually a good rule of thumb for me also to take.
Great. That's what I'm here for. I'm here for you. So let's talk about saving and budgeting. Everybody has a magic number. The amount you want to save to buy a house or pay off a debt or save or have in your bank account for a retirement. I want you to think about a number. I'll give you an example. Very good friend of mine. She said to me, maybe it's about 2 years ago now, she said to me, Bev, I need to save $10,000. I think at the time she was 28 or 29. And she was like, I'm not really sure how I'm going to do this, but I need to find a way to save. So at the time, we get paid every 2 weeks. So I said to her, fine, that is your magic number, 10,000. I want you to take $10,000. I want you to divide it by 26, because we got 26 pays a year. And that is the amount of number that I want you to allocate to a separate savings account. So that was maybe December, because I saw her, this is before COVID. And then we spoke during COVID, and she said, actually, Bev, I saved that amount of money. It was easy, it was simple. It was a part of my overall monthly budget or spending plan, which I'll get to in a minute. And it really allowed her at the end of that year to save that 10,000. So that for her was her magic number. And that was her to be able, one, to pay back her mom of some money that her mom had loaned her and pay off a little bit of a school loan. But just having that plan set allowed her to figure out what is it that she wants to do. So I'm going to talk about something that people always say, Bev, I don't believe you, but I really believe it's true. I think budgeting sucks. I think budgeting is boring. I think they're complicated. I think it takes time for people to see results. And I don't really find it particularly enjoyable to be sitting down entering numbers into an Excel sheet every payday. So we need to find another way to ensure that we're able to see our savings and see what we're doing with those savings. So I like to call it a spending plan. It's the 20-20-50-10 rule. I want you to start by right here, paying yourself first. You are the most important thing to be paid. You get paid on Monday, or today, what is today, Tuesday, you get $1,000. I'm making up a number. I want you to take 20% of that $1,000 and you get paid first. This could be for you to invest in, put into an emergency fund, whatever. But that 20%, which is out of that $1,000, is $2,200. That goes to you first. Then I want you to pay your rent, your mortgage, your utilities, your phone bill. From that, I want you to tackle some debt. We'll get into debt in a minute. That is really something that is hard to manage and handle, is managing debt. I really want you to nip it, because typically credit card debt is one of the highest interest rates that we are paying right now. And then we need to live. I need you to have at least 10% of that money for fun. I want you to go out and have fun, and don't feel guilty about, I want to get a pair of shoes, or I want to go to this dinner or this concert. We need to be able to enjoy our lives as we're being financially stable and financially respected. So forget about the budgeting. I want you to think about a spending plan. You could go to my website and there's a free tool that talks about this exactly. You type in the number and it automatically gives you these percentage breakdowns. And I just find it makes it easier for you to have a little bit of confidence that, okay, I have everything taken care of for my essentials. I could invest, I could nip my debt, and I could also have some fun.
Bev, I like that, because one of the things I find when, talking about money with friends and with neighbors is that I find people feel it's a sort of an all or nothing. So either I'm a saver or I'm a spender. And so I really like your chart, because your chart sort of says you can still have fun, you can go for dinner with your friends, and you can still save. And that's always the balance that we want to meet. And I think a lot of people are scared to start saving because they feel that means they can't enjoy life, buy that pair of shoes, as you said, bacon and heels, the heels part. And so that also is, I think, a very manageable thing to just say to yourself, I'm still going to do that dinner once a month with my group of friends or my family out and enjoy that. But also know that out of my savings account, $50, $100, $200 is going in. So
Exactly.
I like that balance that you've created.
And balance is key. I know everybody says balance, but it really is key. But a spending plan allows you to have a track. I could spend 10%. I have $100 with this pay that I could spend on whatever I want. Whatever I want, you could spend that $100 on. And it's really interesting. When I started this a couple of years ago, as I mentioned, people wasn't really talking about money, the ladies, but all of my male friends, we talked about it all the time. They talked about stocks they bought, how much interest they're paying on their credit card. They talked about mortgages and how much their mortgages are. But my girlfriends, we weren't talking about it. And every year before COVID, I have about 6 to 8 ladies that come over for dinner. And we have a great conversation. And I started bringing it up. And people were eager to talk about it. They just thought, oh, again, it's rude to talk about money. And it really is not. You don't have to share all your deepest financial items. But if you're having a problem with something and you want to say, hey, how much interest are you paying on that Visa card? Or our SP season is coming up. And I ask my friends every year, where are you putting your money this year? What stocks have you bought? Those are great conversations to have. And this really just provides you with a roadmap, guide rails to help you move forward.
Yeah, and I like that idea too that you're talking about, that to start talking to your friends about money, because I find it's something still we don't talk about. And I had an interesting conversation with a friend just recently about both of us took new jobs and how we struggled with negotiating for better pay for ourselves. But I feel like the start of negotiating for better pay is actually understanding your own money and finances and owning your money, as you say, creating this spending plan. So I think it does create a platform to build on the other skills to talk about money. And I agree with you. I think men go in and ask for raises and talk about money, and it's connected to their ownership of their finances. So I think you're right. Ownership of our finances, women, whether we're 22, 32, 42, 52, and following this spending plan will allow us to also push those limits in other ways in our
Absolutely.
Work.
One of my upcoming posts are going to be on how to ask for a raise. And if you don't get one, what do? How do you plan so that next year you have like a roadmap so that you can do that moving forward? So that's coming out in a couple of weeks.
That's great. I'm going to look for that also.
Cool. All right. So retirement. I know you're thinking, oh, man, I'm young. I need to think about this. Yes, but like I said, the past 20 years have flown by like this. So starting to just put money aside every year to an RSP is key. Not only does an RSP in Canada allow you to have the tax deduction on your income, but it also just really is a great way to make sure that you are saving for your golden years. And golden years don't always have to be at 65 or 70 whenever we could now be retiring. It could be if you're 55 and you've saved enough and you're like, I'm done with a full-time job. I want to take a year off and do something different. That having that money aside there for you allows you that flexibility to do what it is that you would like to do. Not with
Bev,
somebody
can
else's.
I ask you a quick question? Just
Sure.
on that note. So when you talk about your RSP, what would you say to there's lots of people out on this webinar, I can see we have lots of participants and attendees. So what would you say to them in terms of, would you put in your RSP first through an investment account, or would you start a savings investment account? What would you choose if you really only can start with one?
It really depends on the entire plan of that person. So
Okay.
I really believe in the ability to put in as much as you can to lower your income so that you're taxed in a different bracket. Typically, you would get back a refund from that because the government is saying, thank you for taking care of yourself in your old age. Here is a nice refund. I would take that refund and put that towards a debt. Now, if you're one of the lucky few, like a friend of mine who has no debt, her mortgage is paid, she's doing very, very well. She worked like an animal to get there, but doing very well. Every year she takes that refund, she divides it in two. Half of it goes to help her pay her taxes on her home, and the other half she puts into her TFSA. So again, I don't think it's a one-stop shop for everybody. You need to really take a look at your holistic, all your money together. But if you can put money aside in RSP, it's great. I always say if you have a problem and you have debt, still save for your retirement, take the refund, put it towards that debt. That's my approach. That may not be the approach that you will need to take, but again, talking to your financial advisor or planner will be able to help you create that plan, because he or she will have a bigger picture of everything that's around you in your life. But
okay, thanks. That's helpful. We have in the chat a question about how about putting your refund into the TFSA, and I think you just answered that. Really, you just said
yes.
You got to look at your big picture. Think about where you pay yourself first. So is that a savings account because you're saving, for example, for a specific reason like a vacation? If it's towards your debt, if it's towards TFSA or RSP. So I think that you've covered that. So we'll let you move on to your next point. Thank you.
Yeah, sure, no problem. But I'll answer that person for the TFSA. I think the TFSA is like magic. I really, really do. What an opportunity. Yes, we're taking after-tax dollars and putting it into this account. But in that account, you could do a variety of things. You could hold stock, you could hold bonds, you could hold whatever you like in that TFSA account. And whatever you make on that account is tax-free. That for me is magic. A friend of mine, her son, who turned 18, he had opened an account right before COVID, and all the money he gathered from, part-time jobs and gifts and like, he took all the money, I think it was like $3,000, and he bought Tesla shares at like $190. It was really early days. Over the course of COVID, as you saw, the stock went crazy. He sold it at $1,700. So at 18, 19, he made a lot of money. All of it was tax-free. Now he's using that money to help pay for his university. So we have this beautiful tool that the government has given us. I don't think many people are maximizing it. So if you are thinking about opening up a TFSA and putting in, like the gal or gentleman said, taking that money and putting it into, taking your refund and putting it into your TFSA, I think that's a smart money move.
Thanks, Bev. That's great. I did get another question just about whether we can recommend any financial advisors. And I would say, no, the seminar is really about understanding your money. We don't make any specific recommendations here because we're not affiliated with any specific people. We don't take any money. Bev does this on her free time. I do this on my free time to advance women in leadership. But I would say, as Bev said, you can go to your bank, you can do some research, ask your friends and neighbors, your parents, cousins, someone might have someone, but you can also go to your bank and use if you don't know anyone, you can go to your bank and use one of the bank employees where you do have your savings and checking account.
Exactly. And go and have a conversation. Just because you met that person doesn't mean you need to sign with them if you don't feel comfortable or you want to do something else. Having a conversation, I think it's good to interview these people. What is their methodology? What is their thoughts for your plan moving forward after you have a good conversation with them? So yes, go and meet people at your bank, and that's one of the easiest ways to get started. So people always ask me, how much Bev do I need to retire? And people are like, what's the complicated, this is the, I forget what actual equation this is, but it doesn't need to be complicated. It really depends for you. It's not a one size fits all answer to the question. What is it that you would like to do in retirement? Do you want to sell everything and go around the world and live in like Costa Rica? Do you, like this gal here on her nice hammock? Do you want to live closer to your kids or your grandkids? So you would sell your home and go into a smaller condo? It all depends on what you're looking for. But there is a small formula. Typically, people are saying take 70 to 80% of your current annual income, take that result and multiply it by 25. That gives you a ballpark of what you could be looking at in terms of how much you would need to save for retirement. So here's an example. If your income is $75,000, you take 70% of that, that equals 52.5. You multiply the 52.5 by 25, which equals 1.3 million. That is the amount in order for you to live like you're doing now on your current income. That is the amount people are saying you would need to retire. Now, I know that number seems massive. That is why we talked about in the beginning, where are you today? What is your net worth? All of these things that if you want to sell everything and put it into your retirement, all those assets are worth something. That is where you could start. So it's looking at your income today. How much do I need to actually live on? If you could live on 70% of that income, remember, you won't be making an income. You're going to be withdrawing income from different accounts like your RRSP, which actually turns into an RRIF. But we'll save that for another session. But you will not be making as much as you're making today because you'll have less expenses. You're not driving to work every day. You don't need, maybe you don't need 2 cars. You need 1 car. You're not need clothes. Your expenses typically get less. So you will not need that much money to be living. So again, takes into consideration everything that you own, everything that you owe, and what is it that you want to do in your retirement. My neighbor, he golfs all year. In the winter, he does indoor golf, hitting balls. That is his thing. He just wants to golf. He's a single guy, very nice man, has a beautiful garden. He enjoys a really smaller life because he was a crazy busy for 35 years working. So this is his way. So he's making less money, bringing in less money, but he's having a full life that is according to what he would like to do. So I want you to really think about that. Does that make sense? I hope it makes sense.
I think that, yeah, that really does make sense. And I think it's like what you said, how do you want to live? Do you want to travel a lot? Thinking about that, do you want to travel a lot? Are you happy? Do you want to just sort of downsize to a smaller apartment and not have to worry about house maintenance and go out with friends and go to restaurants? Or do you want to buy a small cottage, wherever you live outside the city to enjoy that? So I do think you're right, thinking a lot about how I want to live when I retire or even as I get older.
Exactly. Perfect. So the next thing I want to talk about, ladies and gentlemen, are debt. It's amazing to me how high interest rates on credit cards are. Right now, a lot of people are, you go to the grocery store. I saw yesterday 2 heads of romaine lettuce were $7 at Loblaws. Like 2, and they weren't like these big, massive heads of lettuce. They were like, regular, kind of skinny. And I really started thinking about, geez, things are getting more expensive. More people are putting things on their credit card. And paying off debt is not an easy task, especially if you're paying the minimum that is due each month. So to get you free and clear, you're going to have to accelerate payments. So if you're carrying some debt, the way to get out of the debt, there are 2 ways. The first way is called the debt snowball. So think of a snowball rolling down a hill. You start by the smallest debts that you have first. You get them out of the way. So let's say you have 4 debt. The smallest one is one you start with. You pay the minimum on the other 3, and you nip the smallest one first. As soon as that gets done, the next month or the next couple of months, you take what you were paying on the smallest debt, you move it over to the second smallest. You keep on paying the 3rd and the 4th debt, and you try to accelerate. So every time you pay off one, you just take what the money you were paying that one off with, and you just bring it down the hill, so that at the end, you have this huge snowball of all your debts that are being paid. So you really start with the smallest one, and then you roll over, make your way over to the largest debt. Now, this is a great way because it allows you to build confidence and tackling these debts. So what you would do first is take a look at all the things that you owe, especially credit card debt, school, car, whatever, and I want you to line them up if you choose this approach by smallest to largest. The other side is called the debt avalanche, which is where you put money towards the debt with the highest interest rate and then move down to the next highest and the like. So right now in Canada, the average interest rate on credit cards is 19.65%. That is massive. Typically, if you would only pay the minimum on a debt that is that high, it will take you years to pay off something. So if you buy a pair of shoes for like, you're fancy, the $500 pair of shoes, and you just pay the minimum, which is typically like $5, $8, $12 on those shoes, it will take you 9 to 12 years to pay that shoe off. And by
think about
shoes are on, or it's, I'm sorry?
No, I was just going to say, and think about how much of your income each month you're losing to a bank, right? When you're, whether it be, as you said, cars, school, credit card, but over the course of years as women in our careers, to lose that interest rate to banks is especially where women often during some of their years raising children maybe take on slightly more part-time work or less full-time work. So I think the idea of sort of paying it down as soon as you can and tackling it one by one is a great idea. And do you have any recommendation whether the debt snowball or the debt avalanche? I mean, right now it seems like the debt avalanche might be the way to go given our high interest rates. Maybe in prior years where our interest rates were pretty low, you might choose the debt snowball. But what's your recommendation between these two?
I like debt avalanche because seeing a high interest rate like that really gets me stressed. It really does. I really feel it in my body. And that's why for me, I use in my fun category, that is how much I put on my credit card each month. And each month my credit card is paid because I know what it's like when you have a high interest rate and you're like, holy smokes, I can only pay X amount of dollars. And then the next month the bill comes and you didn't pay it off. So it goes up again. So that stress really empowered me to say, okay, I need to nip it. So for me, debt avalanche works well. But another good friend of mine, for her, the snowball works well because she needed to dig her way out of a lot of debt. And starting with the smallest one helped her to build confidence to say, okay, I nipped off one, I'm nipping off the second one, I could keep on going. And that gave her that momentum and energy to continue. So it all depends again on your specific situation that you're in.
Right. And it sounds a bit like personality too, what you can face. The point is just to face it, right? And that's exactly the main point of this seminar.
Exactly. We have another friend of ours. She took a part-time job. This is many, many years ago now, but she took a part-time job on the weekend. She's like, this is really crazy. And it really helped her to nip it. So it all depends on where you are in your life and what it is that you like to do.
Right. And this is a time too, unless you're really, really have to, is to think about, I went through a period where I wouldn't use my credit card. I'd only use my debit card because the interest rates were so high that I thought, if I'm going to buy this, I have to be able to afford it. The only way I really know if I can afford it is if it's right out of my bank account. And then I know the rest of the month, I can't buy any shoes or clothes. I've got my rent. So that's another way, but it's not always possible, I recognize, for people.
Exactly. Again, it all depends on who you are, what your financial situation it is. But yeah, but you found a trick that works for you. And I think that's the most important thing. Whatever works for you is the right way.
Right. Right.
You are the master of your financial future. So whatever works for you is the way that you should be moving forward. So another tool. This is something I always found interesting. So this is a tool that I created. I'll send it out with the next couple of weeks here. But again, it's interactive. You type in the number that you want to pay off, and it tells you by percentage how much you have to go. And what I found interesting is there was a stat that said, if you see that you are making progress with that debt, you are more likely to pay it off. So a good friend of mine, she's using this. She printed it out. She taped it to her fridge. So every time she paid down the credit card debt, she just scratched a line off, like a line in between here. She just scratched the line off. And at the end, she had these scratches right up to the top when she was debt free. And for her, I thought it was really interesting. She saw it every single day. She got up in the morning, went to get a cup of coffee. I got to get this down. It really was a part of her routine. So when we would go out and get a coffee, that's fine. But if you wanted to go shopping, she's like, nope, I'm not going. That debt is looking at me every day on her fridge. So do what you need to do to be able to see it. I find that really helps. And then according to the stat that I found online, 32% of people that actually track their debt are able to pay it off faster because they're seeing it every day than people that do not track. So just another tool for us to move that forward. And then last, but certainly not the least, I need us to own our own money. And what that means is taking stock of where you are today, making a plan for your tomorrow. And I think as women, we just need to be a little bit more confident. I'm not saying go crazy and start buying all kinds of stocks and buying houses and real estate. I'm just saying be confident in your ability to manage your money. And yes, get help from professional people, but you know how much you have coming in. You know what your debts are, what you want to buy. Just be able to talk about it with your friends. Sit down with a piece of paper and pencil. I know I'm a little old school, but just sit down and write it down to be able to really see where you are. And one thing that I would love to stress to anybody, you do not need to buy everything. You know, Black Friday's coming up on Friday. All my American friends are like, we're gonna go shopping or buying this TV. And I'm like, do you really need like a 95-inch TV? You have an 80-inch TV. Oh, it's on sale. You do you. I would not buy that because I don't need another TV because it's, $100. So really think about where you are, where you want to go. And every time you think I want to buy something, just really think for 1 second, do I really need this? Just that one little pause could save you thousands of dollars a year. So in summary, like I said, I started Bacon and Heels a few years ago to really talk to women about making money, managing money, investing their money, and of course, talking about money. I really think talking about it is the way that we could overcome any fears and really start to take control of our financial future. So I'll leave you with 5 things. I want you to be honest about your needs and wants. I want you to look at your net worth and you leverage that tool that you're going to get momentarily. Type in those numbers and really use it and try and see where you are today and then where you want to be. That's going to help you determine where you want to be. Budgeting does not work. I really want you to automate your savings, and you automate it by using a spending plan and allocating at least 20% of your salary towards you. You get paid first. It's never, ever, ever too late to start to invest. So if you're 65 today and you're like, I want to jump in, I encourage you to do it. If you're 25 today and you want to start, I'll encourage you to do it. The whole point is just start. And one of my things that I love to say is financial literacy is a life skill. Like driving, riding a bike, learning how to swim, learning about how to manage money, I really think needs to be taught in schools. I really do. It is not. That's a huge hill to climb. And I think places like what I'm doing and multitude of other women around the world are doing are just imparting our financial knowledge with women from around the world. I think it's really important for us to build that skill of financial literacy and personal finance. And please crush your debt so that you could continuously invest. If you have a lot of credit card debt on you, I really encourage you to take a look at it. I know it's hard to sit down there and see how much you owe, but tackling it is by understanding how much you have, how much you owe, and then putting together a plan to nip that debt. And then you could use that money for other things that are important to you and your family. So, what questions do you have for me? I learned this week that you're not supposed to say any questions. You're supposed to say, what questions do you have? So I'm implementing this new learning that I learned this week.
I like that. I hadn't heard that, Bev, so I'm going to implement that too. So I do have 2 questions, and I think, and I'll jump right into those since we're getting near the end of our webinar and everyone has to get back to their regular day jobs. But the first question is, how much should you be putting in your RRSP? And I think you'll be able to answer that quickly for someone. So jump into that one.
Sure. So every year the number from the CRA, the Canada Revenue Agency, changes. Last count, it was 18% of your income you're able to put into your RSP. And I think the number is $21,000 max a year. I have to go back and look, but I could answer you guys after in a Q&A. Oh, we could do that. We could take a Q&A of all these questions, write the answers and share with everybody. We could do that as well. I'll get that organized.
Yeah, so I think everybody's RRSP, as you said, is dependent on their own income because it's 18% of your income. So if you make,
but there was a cap. I just got to get you that cap number. I think it was 21,000.
Yes, I believe that's the cap. So most of us don't hit that cap until much later in our careers, but some of you as young earners may have that, or if you're living at home and living with your family or family members and are able to take your rent and apply it to your RRSP or other income savers, then that's very helpful. Someone said, I've heard a friend say that the RRSP makes sense only if your income is at least 80,000 annually. Is there if you're lower income, is there a better option? What do you think of that statement?
So that's a great question. So there's 2 things. One, remember, RRSP is to help you save for retirement. And that's the number 1 goal. But number 2, the bonus is you're lowering your income. So let's say you make $50,000 a year and you're able to put in, I'm making it up, let's say 10,000. That means you're not paying tax at 50,000, which is taxed at a higher rate. You're being taxed at 40,000. There are benefits there. I think if you're able to put in even a little bit to help you not pay any tax at the end of the year, that would be a benefit. And then, like I said, the bonus that you have, take that bonus, the refund money, take that money back and then put that into a TFSA. A TFSA is another great way for you to save money and grow that money tax-free.
And that's actually good. It's good. I've been thinking about that too, as you stated it. And I like that idea of taking the refund, putting it into my TFSA. I never thought of that direct connection. I would put money into my TFSA, RRSP over the course of a year, try to do that. But I like the idea of designating your refund, if you do get one, into your TFSA. And I also like the idea that I always say to myself, if I have a refund, I will take 5 or 10% and do something nice for myself, something I didn't expect to get that money back. So
exactly. We need
I like
to
that.
live, right? We're not just here to work and save. We need to live.
And I think it's important to recognize you can still live and have fun, but also be a saver so that by the time you get to your retirement, you can have met both those goals. The last question I have is there, from someone is in the group chat, it says, is there a good place to teach kids financial literacy? And I agree with Bev. I think the biggest disservice we do our children is not teaching this in the school. I think this is something that I'm trying to teach my kids as I become better educated, and my kids are now 18 and 22. But if I could have had some of this information, I probably would have started them a bit younger. So where do you recommend? I think your website's a great website to try to keep.
Oh, thank you. Yeah,
I think your
yes.
Your website is clear.
Yes too.
I would think, yeah, go ahead.
Banks should start. I know some banks are starting getting kids involved and getting their own bank account, so they're starting. I think start with the basics. I can do a post about this as well if people would like. They need to understand what money is. How do you teach them what money is? All they see is, when I was a kid, I remember mom put her hand in her purse and took out some money and paid, or she took out a credit card, right? They have to understand where the money comes from, how much it costs to live. One learning that I could share is my dad always told us, this is how much the mortgage is. So if you want to go on vacation, this gets paid. Whatever comes out after, we can take for vacation. We have to plan for vacation. We're not going to do that dinner tonight because you want to do X. So I think it should start from home. And if it can start from home for whatever reason, there are resources through banks and online that could help, especially for kids. And I think them starting with a piggy bank, what a great way to show them, they got, I'll make it up, $10 for Christmas. Half of that money goes into the piggy bank, half goes for fun. So we could start them learning that saving motion so that as they get older, it's not foreign to them.
I like that idea. It becomes sort of automatic that their brain starts to separate monies, right? That as you grow up 14, 15, whether you get birthday money, holiday money, that your brain starts to always separate that money into different categories. Okay, so I have one other question here. It says, hi, I've been investing in the stock market, but I'm losing money. Do you have recommendations on what to read or courses? And this person says, maybe it's just not for me. And I would say it is for you. That's the whole point of this seminar. It's for all of us out there, whether you're male, female. So do you want to address that issue of losing money?
Sure.
You talked a bit about it at the beginning, but maybe worth reinforcing. And my recommendation is to look at Bev's website, use her website as a resource, the worksheets, everything in terms of investing, how to invest. And that's a good place to start. But why don't you go ahead and just talk a bit about,
Sure.
losing money in the stock market and concerns for people doing that.
Right. Okay. So technically, you haven't lost anything yet because you haven't sold it. You only lose when you sell. So yes, I have had many days thinking, holy smokes, the market has taken a turn. And it really took a turn with a lot of external factors that are not in your control, right? What's happening right now horribly in Ukraine? What's happening with oil and gas prices? Inflation and the government stepping in and raising interest rates. All those things, those external factors play on the market. The market is really moved on two factors: fear and greed. Those are the two things. When people are greedy and things are flying, the market is flying. When people are scared, people start holding back and selling, the markets go down because of all the external factors. I would 100% say, look at your stock mix. Look and see what you're buying. Are they all the same? Retail stocks, utilities, things like Amazon, whatever they are. Take a sit down and take a look at what you have now. And if you've made any money on some of them and you feel I need to get out, maybe that could be a time. But I don't want you to sell just because the market is going down. And especially if you have time on your side, because typically the longer you stay in the market always recovers. Well, historically, like the S&P 500 always recovers. So if you could just hang on for a little bit more, take a look at where you are, you could definitely take a look there. If you want, you could email me and we could talk about it more. I'm open to that as well. I could give you some other insights.
Thanks, Bev. You're just a fantastic resource, and I wish I had met you when I was much younger, but I got to know you now.
Exactly. We're friends now. It's all good.
Yes, exactly. And I hope everybody in this seminar. I have one last question, then we'll jump off.
Okay.
Because I know we're almost at the end. So the last question is just,
two more slides after this.
Sure. Where to find resources to understand mortgages, when and how to switch without losing money, especially now with the super high interest rates.
So number one, you got to go to your bank. Whoever your lender is, they're going to be the one to help you figure out what that mortgage number is. And I want you to educate yourself on the different types of mortgages. People always say, oh, there's fixed and there's variable. Yes, but there are different types of variable. So there's one variable where let's say your mortgage is $1,000 a month. Regardless how the market goes up and down, you keep on paying $1,000. The amount of $1,000 that goes to the principal and the interest changes, but your amount that comes out of your account stays the same. The other more traditional variable one is every time the market rates change, then you see your payment go up or down to manage the market. So talk to your lender or your bank, tell them that you want to have, this is where you are at right now, what your number is, and then you need to shop around. It's like you're dating somebody. You gotta go check out everything that's out there before you say, I'm gonna select this one. Do not be afraid to go and look around at different rates. And if you do switch you may have a fine, not a fine, a penalty to pay with your current lender. If you want to switch, make sure that the place that you're going to would cover that penalty. Or the bank or the lender that you currently have, ask them if you want to make a change. Like, tell them, I don't want to pay this penalty. What can you do for me? Be confident to say they don't want you to leave. They want you to stay with them at that bank or that lender. So you work with them and see how you can help. They can help you get to where you need to be.
I like that point because I think you're right. Going back to one of your first points you made, and then we'll sign off for everybody. But I think that point is really important. For example, when I started, looking at all these things, I couldn't figure all these things out. So the point you're saying to talk to people, listen, go to your bank, ask and negotiate. I didn't know women could do that, right? So I never learned that we could go to our bank advisor. I thought we just had to accept what the bank did. I went and called Rogers and negotiated my fee for them after their big blackout across the country. So
we are the majority.
Right.
It is up to us to say, I'm sorry, I'm not paying that. What can you do for me? Could you please help me? If you ask for help, the person's not going to say no. Exactly. We're just coming up on time here. I have two things I wanted to share. Sure. If you want to follow me online, that's my Instagram handle. You can check out all the resources on bacon.heals. I'm actually changing up the website. I love it, but I like to keep things fresh. So I'll have another page to share all those resources that you could you could download to get sign up on baconheals.com, and we'll go from there. And then last but not least, we are giving away a little bit of money. We thought it would be fun to help you on your journey. We're giving away 4 $50 gift cards. You can spend it on whatever you want. Pay a bill, pay down a debt, buy something nice for you. But we thought, wouldn't it be nice to always give back to the people that took time out of your day to come and join us? So we're going to draw 4 names after this session. And we'll put it up on the WIL site, and I'll put it on LinkedIn as well, so that you guys can get your gift cards. And then you just gotta tell me what you did with it at the end. That'll make me very happy.
I like that, Bev. Thanks to everyone for attending. I'm going to close out the recording. We're really thrilled to present you with all this information and assist women in understanding their money and owning it. So have a great day, everyone. Thanks to Bev, and look forward to seeing you soon. And we will let everyone know who won our 4 $50 gift cards.
Yay!
Have a good day,
everybody. Have a great day.
Thank you.